saw this for the first time, I certainly didn't believe it. I was an advisor and I thought there's no way it works this way. I was never taught this. Just like that guy on Instagram's financial advisor. No way this works. That infinite banking thing, that's a scam. There's no way. It's too good to be true. Can't work that way. I know, I'm an advisor. Okay? That's what I thought. Why? Because I was an advisor. But now how I think about it is, now I understand that I'm in control, and I can be, by changing one thing. And all I do is I change the name on the bank. Okay? If I don't want to deposit my money at Bank of America, I want to deposit the money at the Bank of Noggle. Sounds way better too, right? The Bank of Noggle. TBN Bank. I love it. And if I do that, if I make my own bank, I can't create a regular bank because, I'm not going to play into that. So to create my bank, I have to do what the Rockefellers and the Rothschilds and Walt Disney and Ray Kroc did. I got to go somewhere different. And that somewhere different is nothing more than a giant mutually owned insurance company. Why an insurance company? Well, number one, insurance companies are in the business of guaranteeing things. Secondarily, insurance companies, if you don't already know this, have all the money. You think banks have all the money? No, banks, I just showed you, they just make fake money. Insurance companies actually do have the money. Banks get their money from insurance companies. Insurance companies loan banks giant blocks of money. Insurance companies are where banks take all that tier one capital. Remember from that fractional reserve? Remember the $10, the $9, the $8 that the bank had to hold in surplus? Do you think they hold that money in surplus at another bank? No, they don't. They hold that money in surplus at giant mutually owned insurance companies the same way we are going to teach you how to do that. So the banks have been doing this for hundreds of years. And since 2008, rules changed with banks. They have to hold more money in surplus now. And where does that money go? Mutually owned insurance companies. And how do they get the money into the mutually owned insurance companies? Well, it's very simple. They get the money into the insurance companies the same way you will, through whole life insurance. But not whole life like Dave Ramsey talks about it. Not whole life like you've bought whole life for life insurance. They do it in a completely different way. And if you want to know what that way is, Google BOLI, bank-owned life insurance, and you'll see all about it. And I'm not going to get too deep into that, but this is how they do it. And these are very specially designed and engineered whole lives. And what the bank does, just so you guys understand this, because I'm really kind of trying to help you see how banks do this, is quite simply, a bank is a corporation. And an insurance company will not insure a corporation, okay? A life insurance company will not insure a corporation. It's not a real thing, it's an entity. So they need a body, they need a living, breathing soul to insure. So what does the bank do? Well, the bank goes out and promotes Jim, your neighbor, to the vice president of, I don't know, something. They got a vice president of everything at banks, if you haven't noticed. How many of you have walked into your local bank and just looked around? How many gold or black little name tags that say VP on there did you see? I bet you a couple, right? Every bank has a whole lot of vice presidents, and nobody ever asks, well, why do you need so many vice presidents? Well, the reason is very simple. You see, when the bank promotes somebody to a vice president, the bank instantly gets an insurable interest in that human being. So the bank now has an executive called a vice president that they now can insure. That's right. So now that that's an executive, they're essential for that operation of the bank. So the bank has an insurable interest in that vice president. And God forbid that vice president should ever die, that bank would suffer tremendously. They'd have to find a new vice president of janitorial, and that would be hard. So when they promote this vice president, they give the vice president a small increase in salary. So they get an increase in salary, okay? They give them a fully paid death benefit, okay? And that death benefit, let's just call that $100,000. This is the bonus package that the vice president gets. Okay, they got a fully paid death benefit so that the wife or the spouse will get money should anything ever happen to that vice president. And then they get a deferred compensation. And deferred comps come in a lot of different shapes and sizes, but let me just simplify it. If that employee works for that bank for 20, maybe 25 years, when they retire, the bank will pay them that deferred compensation out in a monthly check. And then that employee can have that monthly check forever. So this is a pretty good deal for the vice president, right? Not bad. But is it a good deal for the bank? Like, did the bank really need all these vice presidents just so they could give them an increase in salary, a paid up life insurance policy, and a deferred compensation plan? No, folks. The bank did this because they needed a body to insure. And the bank went out and they said, all right, big Mr. Mutually Owned Insurance Company, we've got another vice president. Really, another one? That's your 100th this week. Yeah, I know, we're really growing right now. Everybody's depositing their money in the banks, and people are scared. So banks have those FDIC guarantees. So we need a lot of vice presidents. Great. So what do we got? Well, Jim, our new VP, what we'd like to do is we'd like to take out a $5 million insurance policy on him. And what we're going to do is we're going to put X amount of money. We're going to put 2 million, or I don't know, let's keep this real. We're going to put $1 million a year in premiums for this employee. Great. And then the insurance company says, all right, well, Mr. Bank, who's going to be the beneficiary? Well, we're going to make Jim's wife the beneficiary for 100,000 of the 5 million. Great. Who else is going to be the beneficiary? Well, the secondary beneficiary above and beyond the 100,000 is going to be the bank. So just make the bank the beneficiary. Insurance company says, no problem. You're the owner, the payor. So you can also have the entity be the beneficiary. Perfect. Great. So they get this whole deal. So now life goes on. The insurance company deposits, and I'm just making this up, but let's just call it $1 million a year into this life insurance policy, which is nothing more. And here's another thing that I want to be very clear about. And anyone that can prove me wrong on this, please do, because I want you to. I'm not just here talking. I've done my research. I've been in this business a long time. I want you to try to prove me wrong. I do. Fact check me, please. Fact check me, fact check me, fact check me. And here's what I want you to fact check me on. I want you to go and I want you to find out is there any banks buying IUL policies, Index Universal Lives, for their BOLI? Is there any banks out there buying BOLI policies on their vice presidents and using an IUL instead of a whole life? I'd love to know that. Is there any banks going out there and using term insurance for their BOLI? Okay. Is there any insurance companies out there using ULs or VULs or any of these other fancy ones for their BOLI? Because if any of you can let me know that, I'd really appreciate it. Because I've looked, and you know what banks are buying? Not IULs. They're not buying term insurance. They're not buying VULs and ULs. They're buying the most boring, awful life insurance policy, says Dave Ramsey and Susie Orman out there in the world, called whole life insurance. So you got to really make an assumption. If the banks are so freaking smart, and the banks make 500 times more money on that example I gave you than we do, and they do all these really smart things like, and our mortgages make all the money in the first 7 years, 80 to 85% of every payment you make on your mortgage payment goes to the bank in interest. They're smart. So if they're so smart, why are they buying this stupid, terrible life insurance policy called the whole life? There's only one of two answers. Number one, are they stupid? Or number two, do they know something we don't know? That's a good question. And I want you to fact check it and figure out what the answer to that question is. But this is what they're doing, folks. So then let's fast forward. Vice president hits 65, retires. Okay, he's no longer getting a salary. He's still got his life insurance. And now he starts getting, I don't know, let's call it $2,000 a month from this deferred comp. He retires at 65. Life is boring, goes fishing as much as he can, does all the things. And then, at 75, this vice president, he graduates. So he graduates. And a lot of people are sad. He left a legacy. He changed some people's lives. He graduated. He passed away. When he passes away, what happens? Well, there's a $100,000 life insurance policy his wife gets. And she's thankful that he did that. She's thankful that he put 20 years into the bank and she gets $100,000 or whatever it is that she gets in a death benefit, because that's his legacy. Who gets the rest? Where'd the other $4.9 million go? You guys heard me say that, right? The bank? Did the bank put more money than that into the policy? Yeah. Remember, they were putting $1 million a year away. So would the death benefit only be $5 million? No, it'd probably be like 20 million or more. The bank got all that death benefit paid out to them. And all they did exactly what you're doing. But where did the money come from to put into those insurance policies? Where do you think that money came from? It's called Tier 1 capital. Look it up. Tier 1 capital for a bank is your reserves. It's the money that they can't risk. It's the money that they can't put out there in the markets. It's got to be in a guaranteed place. Some of it lands in U.S. Treasuries because they're guaranteed. Some of it, and most of it, especially since '08, goes into these specially designed and engineered whole life policies. That's what they do with it. It's your money funding those life insurance policies. So how about if your name was on the bank? What would you do? Well, first off, as of right now, and this will change, I'm sure. Right now, though, the guarantee is 4%. The insurance company will pay you 4%. And every year, since they're mutual, they will pay you dividends on your money. That's far better than you're getting at the bank. And then if you need the money, what we're going to do is we're just going to take that money out in a loan. Because if you owned a bank and you needed money, would you just go to your bank and take a loan? Precisely. But if you take a loan from your bank, you should always pay your bank back with interest. So if we take a loan, when we do that, the money has to go from your bank, which is being held at an insurance company, into a regular bank. Okay, because you can't get a checkbook with an insurance company. It's all digital. But with your bank, you can get a checkbook. So the money goes into the segregated account. And then let's just say you got an LLC and you're going to buy a real estate deal. So let's say you took a loan for $20K out of your bank and you lent that money to your business at 6%. Let's just call this the promissory note. Okay, there's a note here and it's a promissory note. So you're going to lend that money to your business. Great. So you charge yourself 6% on the money over 1 year or whatever time frame it is. Now your business has $20,000 to go out there and buy this real estate deal. Then this real estate deal puts $1,000 a month into your entity's bank account. And out of that $1,000, 6 on 20, I don't know, what is it, $600? Whatever, I'm making numbers up. Your rental property pays your bank back $600 a month. The same amount you would have given to somebody else's bank, you just put it back into your bank. So now every single month, your bank gets $600 a month, but you're charging 6% on your money and you're making 4%. So you're making money twice. But what if you did this same exact example, but you did it with buying cars, or you did it with paying off credit cards, or you did it with vacations and taxes, and I could go on for days. All I'm telling you folks, and I just wanted to give this example because I wanted to kind of help you understand, this is kind of the foundation that we build off of, because this is what we got to get first. We got to get control. Just like that first slide said, the very first thing you need to do is you need to figure out who is going to be in control of your money. What I just showed you is how you can be in control of your money. Our whole lives, this has been there. I mean, the banks do this every single day, and, big money does this every single day, but yet we're never taught to do this. And, we're taught to give up control of our money to somebody else, and somebody else does this for us and makes all the money on it. And we get paid peanuts if you're even lucky to make peanuts. So sometimes you got to ask yourself, why don't I know about this? How come this isn't mainstream? How come not everybody's teaching what you guys are teaching? Like, it seems like if it was so good, everybody would be talking about it. But in that exact statement that you're thinking, or maybe somewhere you've thought about that, you need to really ask yourself the biggest question of all. The reason you haven't heard about this, the reason everybody's not doing this and talking about this, is because there's no money in it for the person showing you how. When you invest money in a stock, when you invest money in a mutual fund, an annuity, and any other product that you give up your money and give up control to buy, that person is making money. In this, it's a zero-sum game, right? There's borrowers and there's lenders. Like, in the middle, yes, there's mortgage brokers. You could be a mortgage broker and you could take your commission and everything in the middle, but we're not talking about that. We're trying, literally, what Stephen, myself, and this entire team at the Money School and the Money Multiplier are trying to do is eliminate all the middlemen. Literally, we want to just get rid of all the middlemen, all the people that take a penny here, a nickel there, a dime there. And at the end of the day, when everybody's taken, all of theirs, what are you left with? 10 cents of every dollar. And where did the other 90 cents go? Everybody else. Statistically, we need to eliminate that and take back the money we're giving away, which means we need to cut out the people that are nickeling and diming you. And unfortunately, that is a zero-sum game. When we get rid of all those people, we literally get rid of all those commissions, all those fees, all those extra things. Because in this game of being your own bank, you are the bank. And when you're the bank, you're the source. which means you have the knowledge. That's the only thing you need is the knowledge and the ability to apply it. You don't need anyone in the middle. Sure, there might be bits and pieces you'll need, an attorney, but if you're on the head side, who pays the attorney? I want to ask this for the glasses. First person that gets this right. If you're on the heads, you have money and you're looking to make that money work for you. You have money and you want to make more money. Who pays the attorney fee in a lending deal? Who's the one that pays that? There we go, Mary. So Mary, send us your address and I'll mail you the glasses. That's correct. It was an easy question. I didn't say it was going to be hard.
Mary's fastest.
The borrower. So Mary just has to send that. And you guys are all getting it right. You just got to be quicker, right? Yeah, you guys ever see Jeopardy? It's not about who has the right answer. It's who's got that clicker the fastest. So Mary gets that one. But yeah, so it's the borrower. The borrower bears the cost. The lender, the bank, the person who's the bank doesn't really have any expenses. Do they? I mean, outside of maybe the expense of buying the private money club, but outside of that, what are your expenses? Nothing. You have everything to gain. Now think about a bank. Doesn't the bank make the lion's share of all the money with the least amount? They're using your money. Yes, they got the branches. Yes, they've got staff and all that. Put all that aside. Like they're using your money and lending your money out and making it. You can do the same darn thing. And that's what we're trying to help you understand, that you need to get rid of all the people that are nickel and diming you and learn how to do this. The reason nobody's showing this to you is because nobody can get paid to show it to you. And like for us, like I want to be perfectly transparent, Stephen, like the private money club is $997 to be part of it. That's per year. Now, some of you might think that's expensive. Some might be like, that's cheap, but for what it is, you make that in 1 month in interest payments, depending on how much you're putting out there, but forget about the cost. But outside of that, that's not why we do this. You see, we're smarter than that because we understand that the money is 6 layers deeper than that. The money's not on the front end. Matter of fact, we're going to offer Private Money Club eventually. We're going to have a free portion of Private Money Club. Now, the free, I want to be clear, the free part of it, you're not going to be able to be the lender or the borrower. You're not going to have access to the tools that allow you to actually do it. But let's just say you want to be an observer, right? You can sit in the nosebleeds and you can just watch the show. We're going to have some free offerings like that. We're going to call it the freemium, and you're going to be able to just come in and watch it. But I guess what I'm saying is the simplest part of this whole thing of you being the bank, you mimicking what the banks have been doing for hundreds of years and making what, billions or trillions of dollars. I don't know. What are they making? Making billions or trillions of dollars. What did they figure out? Just one thing different than you. They figured out how to be in control of the money and how to move that money. That's it. So this is how you turn $500 a month into $500,000 or more by using a simple strategy that you've probably all heard of called compound interest. But even though you think you know how compound interest works, you probably don't, because the thing you're doing is you're not earning compound interest like Albert Einstein tells you to do. You're probably paying compound interest. And I'm going to show you not just how to grow $500 a month into over $500,000. I'm going to show you how to do that with working less. I'm going to show you how to do that without taking on any additional risk. And I'm going to show you how to do that by taking control of your money. And then we're going to add on something called uninterrupted compound interest. And that's where this is going to get really fun. So you saw my friend Albert Einstein talk to you a little bit about what this all is and how it goes and what he said. But the other thing that's important to understand is not just what he talked about, but it's important to understand some simple things. And the simple things that I want you to understand are this. Would you rather have $500,000 right now? Would you rather it if somebody just gave you $500,000? That's option A. Or option B, would you rather 1 penny, that's right, one of those little pennies that doubles every single day for a period of 30 days. So which one would you have chosen? Would you have chosen A, which is $500,000, or would you have chosen B, 1 penny doubled every day for 30 days? So some of you would have taken the 500 and, well, you made 500 grand. Good for you. For those that took the penny doubled, you would have made $5,368,709.12. But let's break this down a little bit more. See, here's the numbers. You might be asking, but how does that work? How is it that 1 penny doubled can make over $5 million? It's simple. It's what Albert Einstein talked about in his idea of compound interest. And here's the numbers. The first day, you put a penny in and it doubles, so you got 2 cents the next day. And if you take that to day 15, as you can see on this chart, day 15, you got $163.84.
By that point, you're probably saying, boy, I made a huge mistake. I wish I would have taken that 500,000, right? Is that what you would have said? Well, let's keep going. Because if you just take that forward all the way up to day 20, that money, that penny doubled, would have gone to $5,242.88. You'd still be upset. You definitely would not be happy about having $5,000 when you just gave up the opportunity to $500,000. But now, if we just go to the 30th day, you now have over $5 million, as you can see. But you see, your money really didn't get to be more than the $500,000 you initially could have taken until day number 26. What you just saw and what these numbers demonstrate is nothing more than compound interest. The ability for your money to multiply based on that simple idea. But is that idea so simple? Well, let's look. Let's look at a more real world example than a penny or $500,000. Let's just look at a 1% interest rate compounded. So let's just assume that you take $10,000, you put it in a bank account, okay, or a money market account where it earns 1%. Well, in year one, your $10,000 would have made $100. Whoop-de-doo. So you got a $10,100 balance at the end of the year. But by year two, you're now compounding on $10,100. So now that gets you an extra dollar. So now you have $10,201. Okay? So now in doing that, you can see you made the 100 plus an extra dollar. That's compounding. And if we just keep going, year three, the $10,201 makes $102, meaning you have $10,303 that is now compounding at 1%. And we can keep doing this all day long, but you see year four, you have $10,406. All right, so what if you had a place where you could earn 4% compound interest? Now, I know many of you probably don't have a bank or a money market that is paying you 4%, but let's just look at the numbers. In year one, your $10,000 would have made $400, meaning by the end of year one, you got $10,400. Starting in year two, you're compounding on $10,400, meaning you made an extra $16. So by the end of year two, you got $10,816. But here's where it really starts growing. At 4%, year three, you're starting with $10,816, and that money grows to $11,249. And then in year four, you're starting with that $11,249, and you make $450 in interest. So now, starting at the end of year four, you've got $11,699. Do you see how this works? But, you know, all this is great. The problem is, if you took a withdrawal, if you just needed some of this $10,000 or whatever it's grown to during the course of these 4 years, you would have stopped the flow of compound interest. Your compounding would have immediately been disrupted, and your money wouldn't have grown to anywhere near what you just saw. So what is the answer? How do you actually earn uninterrupted compound interest where you have the ability to access and control your money and earn interest at the same time? Well, that just sounds too good to be true. Chris, there can't be a place that actually does that. But what if there was? What if you could use your money and earn uninterrupted compound interest at the same time? Now that would be a great place to put your money. So what is that? Well, it's nothing more than what the Rockefellers, the Rothschilds, the Ray Krocs, the Walt Disneys, heck, even right into today's administration, before McCain passed, it was widely known he used this, and the Biden family also uses this. And they're not the only ones, but let's just go into it. So what this is an example of somebody who is 45 years old that is saving $500 a month, because that's what we said. We're going to show you how to turn $500 a month into over $500,000 using uninterrupted compound interest, because we want to have the ability to actually put money in and take that money back out and use that money without interrupting the flow of interest like the prior two examples would have done. Because if your money's in a bank account, a savings account, a CD, a brokerage account, mutual funds, ETFs, the second you take that money out, you stop the flow of interest or the flow of returns. In this example, you don't stop that. But let's look at the numbers. So year one, you put in $500 a month. So you put in $6,000, and let's just say you have access to $3,564. Well, if we go to year 11, we're just going to look at year 11. In year 11, you deposit $2,400. You don't keep putting the $6,000 in, and you've put in $62,400, which means you would have, with that compound interest, but uninterrupted compound interest, $63,883. Now, I know what you're all saying. You're saying, well, those returns suck. But hang on, stay with me here for a second. By year 21, you're still putting the $2,400 in. You've put $84,000 into the plan over the course of time, and you now have $126,558. But all of you should be thinking about this saying, I wouldn't want to put my money in and just leave it sit there for that long because these returns aren't that good. But that's not what you would do. You see, this bank, which is your bank, it is a privatized bank that you have created not with a bank, but not with Wall Street, but with none other than a mutually owned giant insurance company. That's right. And what you've used here is nothing more than a specially designed and engineered whole life insurance policy, but not the same one that you'd get from your brother-in-law, and not the same one you'd get from that insurance agent or that insurance store. These are very different. They're designed for banking. But let's get back into the numbers. So year 51, way into the future, you've put in $156,000 and you have $513,000. So right then and there, you now just saw how to take $500 a month, and it's actually less than $500 a month after year 11, but how to do that and turn it into $513,000. There's your answer. But that was pretty boring. Now, what you need to understand here and really wrap your head around this is, what if each year, year 1, year 2, year 5, year 6, year 8, year 10, year 12, every year you put this money in, as shown here, but then you took the money out and you used it to invest in something else. We're going to cover that in a second, but what if you had a place where you could put that money, take that money out, and invest that in, let's just say, an index fund, or invest that in a real estate deal? Whatever your flavor is, if you had the ability to put money somewhere, take that money out, reinvest it somewhere else, and never interrupt the flow of interest that you earn on your money, you would have found a really, really good place to store your capital, which is what this vehicle will do. But let's look at another example. Now let's just go on and let's look at somebody that's young. I'm going to pick on my daughter. My daughter is now 14 months old. When she was 6 months old, we started one of these privatized banks for her. And I put exactly $5,000, as you can see from the slide. I put $5,000 away into it, and in the first year, she only had $22.85 that she could use. But by year 17, we were still putting $5,000 in every single year, and that means we put $85,000 in over those 17 years, but she has $108,000. And then by year 29, we've put $145,000 in, of which she has $275,000 to use. And if we went to the ripe old age of when she's 65 years old, we would have put in $320,000, and she would have had $1.9 million plus to use. But again, you might not get excited about these numbers. You're probably thinking, I could put my money in an index fund and make way more than this. You absolutely could. But what if you could do both? What if you could do both at the exact same time? Why have one versus the other? Okay, why not have one and the other? That sounds a lot better. It's kind of like having your cake and being able to eat it too. We want to be able to use our money, and that's what uninterrupted compound interest can do. So really, when we look at this and you're looking at these numbers, I need you to understand that you have access to this cash. You have access to your capital, and you're still earning interest on every penny of it, even though you take it out. So, a lot of people always say to me, well, Chris, what if I just put my money in the market, in the S&P 500, which is the most common one people talk about. In the S&P 500, you can buy an index fund or an indexed ETF. So let's look at it from where it began. 1926, we got to go back in time a little bit. They called it the composite index, and it was comprised of 90 stocks back then. But then when we got into 1957, there was 500 stocks, so it went from 90 to 500 different stocks. And if we look at the average rate of return, I want to be very clear about this. The average rate of return of the S&P 500 for this entire period of time from 1929 to 2018, it has been between 10 and 11%. But the average rate of return from 1957, when they added all those additional stocks, to 2018 is about 8%. So that seems much better than those returns we just looked at, doesn't it? But again, what if you could make the returns in that privatized bank, and then also make these kind of returns. Well, that would be way better because instead of making money one time, you are able to make money 2 times, maybe even 3 times if you did it properly. But let's talk more about this average rate of return, because I think when you hear that, it's exciting to hear it's averaged 10 to 11% or it's averaged about 8%. But you really know what that means, because I think this is one of those things that I like to call the big lie. So let's really dive into average versus actual rate of return. This is my favorite thing to talk about. So let's take a peek at how this actually works. First off, let's just use a $100 investment. So year 1, you put $100 into an investment, and that investment earns you 100%. You'd be so excited. Your 100 has grown to $200. So by year 2, you're starting with $200, and that money is growing at, whoa, year 2 you lost money. Whoops, the market's dropped and you lost 50%. Not good. But you made 100% the first year, you lost 50% the second year, but your account balance at the start of year 3 is $100. Just doing the math here. So year 3, you've got $100. You're not super excited. And then your investment answers back with another 100% return. You're like, yes. So you're back up to the $200 that you were in year 2. So year 4, you've got $200 in the account. But the market slips and you lose 50% that year. You now, by year 5, so 5 years have gone by and you have $100 in your account. So year 1 you started with 100, and now year 5 you still have 100. That's not a very good investment, is it? Not only that, you've lost money to inflation, you probably lost money to those taxes when you had those good years, and then you probably paid some type of management fee for the investment that you put your money in. So all those things are not factored here. But let's look at the most important part of this. Although you're looking at this saying, yeah, well, that's kind of a terrible example. Do you realize that the average rate of return on that example that I just gave you is 25%? Do the math. Add it up. Okay? Add up all of those and then divide them into the amount of years, and you will see that that is a 25% average rate of return. So now, like what we showed in the beginning slides with what the average was of the S&P 500, whether it was 10 or 11 or the 8%, how do you feel about that, knowing how you calculate an average rate of return? Probably not very good, because your actual return was $0. That's how much money you made. So with all that being said, you really want to learn how this works. You want to learn how uninterrupted compound interest works, because compound interest, although it's great, there is not a company in the world, not a business in the world that uses compound interest. Banks don't use compound interest. They move your money. Car dealerships, grocery stores move inventory off the shelves or off the lot. No business in the world uses compound interest. We are the only ones that have been taught to give up control of our money, put it somewhere, conventional banks, 401ks, into brokerage accounts, and leave that money sit and lose the opportunity to take advantage of new investments that may be better as they come along. But if you only knew how to change one thing, and that one change was taking that same money and putting it into a vehicle or an account where that money can earn uninterrupted compound interest, now all of a sudden you could earn interest and compounding while still using the money, and that is something that every business in the world would love to use, and many do use them, starting with banks. Banks have used this strategy that I just showed you for a very long time, and if you don't believe me, look up BOLI, and if you don't believe me about the companies that use this, look up COLI. It stands for Bank-Owned Life Insurance or Company-Owned Life Insurance. So before I show you how this works, there's really 4 different ways that you can buy a car. I mean, let's think about it. You can buy a car for cash. And if you buy a car cash, the reason you would do that is you got the money sitting in an account somewhere and you don't want a monthly payment. But the problem with buying a car cash is you give up control of that money and you lose the earning potential on all of that money forever. And what you get in return is a depreciating vehicle that will be worth far less later. The second way you can buy a car is you can go and finance the car. And in that, you exchange monthly payments to a finance company in return for the car. And after a certain amount of time, the car is paid off. But you've given up interest payments to this finance company. And the third way, and really the most common way today, is leasing a car. Now, why do you lease a car? Most people would say, I leased because the payment was lower. And that is the most common reason somebody would lease a vehicle. But not only that, you might want tax write-offs for your company, which would be another common answer for why you'd lease a vehicle. But I did say there was 4 ways, right? Well, the 4th way isn't one I'd suggest, but you could always steal the car. But we're not going to do that. So let me walk you through how I did this. But how I did this was I had the money to pay cash for a car, but I wasn't willing to give up control of that money. Nor did I want to exchange that money for a depreciating vehicle, the G-Wagon. So another really cool thing about the Mercedes G-Wagon is it's over 6,000 pounds. And there's a tax credit that you can get called the Section 179 that allows you to get a tax deduction for a big portion of what you would pay for the vehicle all in the first year. But I'm getting ahead of myself, so let me take you through the process. So here's what I did. I took money that I was saving in a regular account and I changed just one thing. And I changed where that money went first. Instead of putting it in somebody else's bank, your traditional bank that you put your money in, I decided to put the money in my own bank, my privatized bank. And how that looks is just like this. So here's what I did. Instead of depositing money in a regular bank account, I changed where that money went first and I put it into the money multiplier policy, which what is this money multiplier policy? It's nothing more than a specially designed and engineered whole life policy. So I, before this, was putting $1,500 per month into a regular bank account. So I put $1,500 a month into my money multiplier account. And the nice thing about this account is it pays me a guaranteed interest rate. Not only that, I get paid dividends every single year. They're not guaranteed, but the 4% guaranteed interest is. So now this plan is much better than my regular bank account because I'm earning interest. Then what I'm going to do is when I save enough money to buy the G-Wagon, which I did, I'm going to take that money out of this policy in the form of a loan. Now, if you went to the car dealership to buy the G-Wagon or a private seller, you would have to probably take a loan out or do some type of financing to buy this. Well, I'm going to treat my money the same as I would treat the bank's money. Even though I have enough money saved to buy this vehicle, what I'm going to do is I'm going to take a loan for that amount. So the G-Wagon was $63,000. So I'm going to take $63,000 from my bank and I'm going to then put it into their bank. As you can see, so we got now $63,000 sitting in what we're going to call the segregated bank account. The segregated bank account is nothing more than a regular bank account, but I just use it only for my banking purposes. Now what I'm going to do is I'm going to go out and buy that vehicle. So as you can see on here, this is the G-Wagon. Now that I bought the car, what I want to do is I want to make the same monthly payments that I would normally make to a regular bank back to my bank. Because if you financed this car or even leased this car from a dealership, you'd have a monthly payment. And I did the math, and I want to show you how I did this. So there's a lot of calculators you can use to figure out what your monthly payment would be. But let me show you what I did. I was saving $1,500 a month prior to that in somebody else's bank. And I just changed one thing. I changed where that $1,500 a month went. And I put it into my own private bank. So let's come down and let me just show you how this works. If I'm saving $1,500 a month, I'm putting that into this plan, and this plan is going to pay me a guaranteed interest rate as of today of 4%. Then I'm every year going to get a dividend on my money that's accumulated in that plan. So that's the reason why I would want to use my bank versus somebody else's bank. Because somebody else's bank, your traditional bank, they're going to be making interest on your money versus you making interest on your money. So then what I'm going to do, remember I buy this G-Wagon. Now the G-Wagon is $63,000. That's how much it is. Now a lot of you are probably thinking you can't buy a G-Wagon for $63,000, but you can buy a used one. I never buy new vehicles because the second it rolls off the lot, you lose all the depreciation right there. So if I just buy one that's a few years old, I already get a much better deal. So this G-Wagon that I bought is $63,000. So in order to buy the G-Wagon, what I'd have to do is treat my money the same way I would treat the bank's money. And if I went to a bank, they would give me a loan for $63,000 and they'd charge me interest on that loan. Now, how much would your bank charge you on a $63,000 loan? Well, that differs for different people, but let's just assume it's 5%. So what I'm going to do is I'm going to charge myself the same exact interest rate that the bank would charge me to buy this vehicle. Again, I'm treating my money the same as I'd treat the bank's money. And now I've got $63,000 after I've taken that loan sitting in my regular bank account. And you can see right from the screen, it's segregated bank account because the only thing I'm using this particular bank account for is the $63,000. And then I go and I buy the vehicle, and that's the fun part. So now I've got a $63,000 G-Wagon. And that G-Wagon, if I did the math, and let me just show you how I did this, because there's calculators you can use online. So follow with me. So if I go into this calculator and I put in $63,000 at an interest rate of 5%, and there's another reason why I used 5%. So when I took that loan from my private bank, the insurance company actually gave me money from their general account, and they're going to charge me interest. And that interest rate is 5%. So just so you know where I came up with the 5%, that's where it is. But 5% isn't much different than what you'd be able to get a loan from a bank for. So if they're going to charge me 5%, then I got to figure out what the payment would be. So over 5 years, which is the term in which I want to buy this vehicle, those monthly payments are going to be $1,312.50. So if I were to pay $1,312.50 for a period of 5 years, the interest that I would have normally given to somebody else's bank is $15,750. Just remember that number because that's an important number. What we want to do is we want to pay ourselves that interest. But now let's go one step further. This is where this gets really fun. For any of you that have a business like I do, you can get a lot of benefits by leasing vehicles through your business. So now, if I were to just take this G-Wagon that I just bought with my private bank, and if I were to structure a lease to my company to lease this vehicle, the cool part is why do we lease? We went over this earlier. We lease vehicles because the monthly payment's lower. And the last time I checked, if you have a business, chances are your business operates with more cash flow being a good thing. So we want a lower payment. But how can we get a lower payment on this G-Wagon? It's simple. What we're going to do is we're going to go to this website. This is what I use. So check this out. So this website will allow you to calculate your lease payment. And if we take the same numbers we just used, $63,000, okay, and we put it in, but when you lease a vehicle, there's several things that you probably don't ever look at. Number one, if you were to go to a dealership and lease a vehicle, they're going to put in a residual value. What that means is after the 5 years, when you turn this G-Wagon back in, they know that G-Wagon has some value left. So what we're going to do is we're going to assume that this 5-year-old G-Wagon, when we turn it in, is going to be worth $38,000, not $63,000. And I will tell you that one good thing about G-Wagons is they hold their value really well, which we'll cover that in a bit. But that's the reason I want to basically lease it, because there's a residual value. But the second part about a lease, as you can see from this calculator here, is we get to build in an interest rate. I bet you most people never even look at how their lease is structured and look that they're actually giving up interest to the finance company or the leasing company. I'm going to build in what most dealerships would, about 8% in interest. Now that 8% in interest is an arbitrary number when we're looking at this, because why do we lease vehicles again? A lower monthly payment. So if we do a 5-year lease on this G-Wagon with a residual value of $38,000 and an 8% interest rate, my monthly payment is $760. How many of you would rather pay $760 a month to lease a G-Wagon versus paying $1,312 to actually buy that vehicle and finance it through a bank? I think you all would take $760. So if I just lease the vehicle to my company, what's going to happen now is after the 5 years of me driving this vehicle, my company has paid those payments every single month of $760. So I got to drive a company car, and my bank, the private bank, got to receive $760 every single month in payments. So let's go over the numbers on the lease. Remember, first, we started with a $63,000 vehicle, being the G-Wagon. And we put a residual value of $38,000. And the residual value is just saying after 5 years of driving this awesome truck, the car should be worth $38,000. That would be our residual value. All right, this is done by every single finance company that does leasing or any dealership you go to, they're always going to build in this residual value because the car does still have value after you're done with it. And with that residual value, I mean, how many of you would like a G-Wagon for $38,000? I think all of you, but that's just what we're saying the car is going to be worth 5 years from now. Now, the other thing we got to do is we got to build in an APR, an interest rate that's going to be charged. So the 8% interest rate, the reason we got 8% is we looked at what the most common interest was on leases, and 8% came up quite a bit. And if we did that, remember our monthly payment on this vehicle was only $760 a month. So that means our company, who is the one that leased this vehicle from our private bank, is going to make $760 payments every single month back to my bank, or it could be your bank. And if you did that, the interest that you would gain, so the amount of interest that you would have normally given up to a finance company, but here, because you are the bank, you actually keep $20,615. But now we got to really look at something important here, because remember, our bank bought this vehicle, and when we did that, we did it with a loan from the insurance company, and that loan was 5%. So we got to factor out the 5% and the 8% that we're charging on this lease. And if we did the interest spread, which is the important part here, the interest spread on this particular deal is $4,865. So what that means is we actually kept interest payments of $4,865 that normally would have went to somebody else, and now we get to keep that. But here's the other thing. In 5 years from now, do we think that this G-Wagon is going to be worth more than $38,000? And the amount that those 5-year-old G-Wagons were selling for was roughly $50,000. So if we did $50,000, which is the sale price in 5 years, minus the $38,000 that we put in for residual value, that means we're actually walking away with $12,000 in profit on that vehicle. So how much did we actually put in our pocket to drive this company car, this G-Wagon? Well, $12,000 plus the interest spread that we made of $4,865. So the total amount my private bank, or me personally, made on this particular G-Wagon is $16,865. That is the amount that I got paid to drive this vehicle for 5 years. And that assumes that I sold the vehicle. The other cool thing is, if you remember earlier, I was talking a little bit about a tax credit, a 179 deduction. So if you really look into the 179 deduction, and make sure you consult with your CPA, but the 179 deduction allows you to take a vehicle that's over 6,000 pounds and used for business, and you can deduct up to $25,000 of that purchase price. So if I get a $25,000 tax write-off for buying this G-Wagon and using it for business purposes, that also is money that I didn't have to pay in taxes that actually could be added to the bottom line. But that might just be going too far, but I just wanted to show that just because that's an important thing to look into if you're doing this. So let's go back to the top and just look at this diagram again to show you exactly how this whole thing happened. Now remember, I was using my own money that was saved in this privatized bank, and it took me a couple years to save this money up to buy this G-Wagon. But I was saving $1,500 every single month. And if you remember, I put that $1,500 into my privatized bank, the money multiplier account. I then took a loan from my policy, which is essentially the insurance company giving me a loan of $63,000 from their general account, and then just using my money to collateralize that. So I have $63,000 that buys the G-Wagon, and the insurance company is going to charge me 5% simple interest on that. But then what I did is I took that G-Wagon and I lease it to my company, my LLC. And the reason my LLC wants to lease the vehicle is, number one, for tax write-offs. Number two, I get to drive a company vehicle for a lower monthly payment. Now that lower monthly payment, if you remember from the calculator we used, was $760 a month, not the $1,312 that we would have had to have paid to someone else's bank, because now I'm leasing it from my company for $760. And we're going to do that for 5 years, and after the 5th year, that vehicle, the lease is over, and the car goes back to my personal bank, which is just me. I want everybody to understand, my bank is just me. So now I'm holding the G-Wagon, and what I do is I turn around and I sell that, and we assumed selling the G-Wagon 5 years from now at $50,000, which resulted in a profit because if you remember, the residual value was $38,000. So if we put in a $38,000 residual, that means anything above and beyond 38 grand is true profit. That's how I made money for driving a company car. And this isn't the only car that I've done this on. I've done this several times. I did it for an Audi A8. Then I did it again for an Audi S4 Avant, two pretty sweet cars. And again, I did that with those cars for a much lower monthly payment than I could have ever bought the car for, or probably even leased the car from a traditional financing company. But again, don't forget the reason we did this is we get all the money back for all of these cars, and we get to drive company cars and get paid for it. I think what you have to really ask yourself, and this is what I had to ask myself, is who do you want to pay monthly payments to? Do you want to pay them to Mercedes and drive the nice vehicle like we're talking about, or do you want to pay those monthly payments back to yourself? Because really the decision is yours. Sure, I had to wait a couple years to save enough money to be able to do this, but once I was able to do this the first time, I now have the ability to do this every single car that I ever buy. And if I did this for every car, I make more and more money, because the one thing I didn't talk about in that description is the fact that my private bank, that's specially designed and engineered whole life, every penny that I put into that bank, even though I took it out as a loan, all of that money is earning interest and dividends. It's called uninterrupted compound interest. And Albert Einstein talked about this a lot. He called it the eighth wonder of the world, the greatest thing and the most powerful thing in the financial world. And he said those that understand it earn it. Those that don't, pay it. The theory of this mathematical equation simply states this: those that understand compound interest shall earn it. Those that do not will pay it. Which side do you want to be on? I then called it the eighth wonder of the world. We have been brought up to believe that we always have to pay interest to somebody else because we don't understand uninterrupted compound interest. Well, I learned how this worked, just like you just saw how this worked. And once I saw how much money I was giving away to everybody else's bank, I knew I had to change something. And what I had to change is who got the monthly payments, who received the interest payments I was making. And in doing this, you see that when I lease this G-Wagon to my company from my private bank, my company gets a lower monthly payment, and my company is also paying interest back to my bank instead of somebody else's bank. That's the whole idea. That interest accounts for $20,615. Even though we got to pay some of that interest back to the insurance company on that loan that we took, I still end up making all of that extra money. So again, I would ask you, do you understand compound interest? And do you understand how to earn it, not pay it? I learned that, which is how I was able to get paid to drive this G-Wagon. So if you just buy a car from a dealership, or if you just lease a car from a dealership, you're leaving a lot of money on the table. In the lease, you're giving all the interest up and you're giving the car back after paying years and years of monthly payments. And if you pay cash for a car, you're actually giving up the earning potential on that money. And then you're getting a depreciating vehicle, which no matter what, cars always depreciate. This concept, what you just saw that I was doing, allows you to control your money, allows you to earn uninterrupted compound interest on all of your money, while still getting the benefit of driving the vehicle that you want and getting all the money back. We don't want to work any harder. We don't want to take any more risk. We really just want our money to start working for us. So how does that happen? First, it starts with one change. All of you have an income. And that income comes in from various sources, hopefully. Maybe it's just one source. Maybe it's a W-2 job. Maybe it's a business. Maybe it's real estate. It doesn't matter where that money's coming. What matters is where is it going right now? My guess is it's going into someone else's bank. Correct me if I'm wrong, but all of your income that you're making is probably going into somebody else's bank, which is okay if it's a stopping point. Think of this as like when you're doing a long drive and you got to stop off to one of those rest stops. You don't stay there. You're not like, I'm home. No, you stop, you get the business done, you get back in the car and you keep moving. Your money needs to keep moving. So what we want to do is maybe stop off here, but then change where your money goes after that. And we want to put that money in that machine, that vehicle, where you can earn uninterrupted compound interest. But it can't just sit there. Not just because this machine, that specially designed and engineered whole life policy, pays a guaranteed interest rate, plus it pays you dividends, but more importantly because it's going to pay you a guaranteed interest rate and dividends whether the money's there or whether you've used that money. So what we're going to do is we're going to move that money. Okay, this is your money in motion. So now that your money's in motion, we're going to stop off at that bank account again, and then we're going to move that money over here to whatever the desired place is. Now, what is the desired place? Remember, the rules that we talked about, we want our money to work for us. Our money needs to make money for us. So how do we do that? First, we would start and look at where is all our money going. You make money today, so where does the money go? Look at your checkbook. Look at your bank statement. How much of it is going to pay debts? How much of it's going to car payments? Where is all that money going? And if we had money in our own bank right here, the money multiplier, how could we make that money work the most efficient? So let's start with the debts, the credit cards, the lines of credit, and all those things where your money goes every single month and you don't get that money back ever again. Once it leaves your family, it's gone forever. And who gets it? The debtors. All those people that you pay money to. So the first thing we want to do is we want to start paying those debts off. And let's just assume that those debts are costing you 10 to 20% interest. If you have credit cards, that's certainly what it's costing you. If you pay the debts off, even if it's not all at once, we're going to snowball them and pay the lowest balance off first, and we're going to move straight down the line from lowest to highest balance. And as we do that, what we're going to do is we're going to take the money that you were giving to the debts, and we're going to then change the name on the check, and we're going to move that money, this 10 to 20%, we're going to move that money back into your bank. It's nothing different. You didn't work any harder for this, you didn't work any longer, and you took on no risk. All you did is went through a process where you changed where your money went first, then you put that money in motion, you paid off debts in a very systemized process, which we teach and we show you how to do for no cost. We pay them off, and then when you change the name on the check, you recaptured the money you were giving away. And then from there, what do we want to do? Well, let's look at the car payments. Let's pay the cars off and take the money you were giving to the car finance companies, and let's put that money in your bank as well. So let's say your car is costing you $500 a month, and these debts were costing you $300 a month. So now what we've got is we've got $500 from the car, $300 from your debts, all moving back into your bank. And remember, all the money you put into your bank, that specially designed and engineered whole life, that never stopped earning uninterrupted compound interest. Never once did your money stop working for you, but you're making your money work even harder. Then when all the debts are gone, what we do is we look at different investments. We look at different real estate deals. Maybe we become a private lender and we start lending money out. Now all of a sudden, our money's making money here, and then what we're going to do is we're going to be making money over on this side. And we're going to just take that money, and again, we're just going to keep moving the money from the real estate, from the investments, from the private loans, back into your bank, because this is what you're doing now. You're doing the same thing. You make money in investments, in real estate, in private loans, however you're making money. Where is that money going? Right now, that money's going in someone else's bank. And someone else's bank is capitalizing on that money. How much? 400 to 1,300% is what BauerFinancial.com says the banks are making on your money that you leave there. In other words, your bank is making 400 to 1,300% more than you are on the money you left there. Why would you want that? Just change where your money goes first. Put it in your bank instead of their bank. Then take all the money that you've made by your money working, the passive income, all these, and move them back into your bank. Your bank never stopped earning interest. And all this interest, the guaranteed interest plus the dividends, the money you made in your specially designed and engineered whole life is also tax-free if it's designed properly. But the best part is, there is a built-in legacy plan. Let's just say something happens and you get hit by a bus. Let's say that plane that was flying with that perpetual tailwind just went so fast that they couldn't miss that mountain and poof, you're off to a better place. Well, you didn't leave this planet, you didn't leave this life without obligations, without some responsibilities. You probably have a family. Well, when your bank was created, remember it's a specially designed and engineered whole life. It also came with a built-in death benefit, or what I like to say is a built-in legacy plan. So when you leave this earth, unexpectedly or expectedly, you leave a legacy to your next generation. Why do you think the Rothschilds, the Rockefellers, and these wealthy families get wealthier every generation? It's because their money's always been in motion. It's because they've never not earned uninterrupted compound interest. But also, when one graduates and goes on to a better place, there's a windfall of money that comes into that family, usually into a trust, that then perpetuates that family's ability to do more of this. So in order for your money to work harder for you, without you having to go out and work harder for that money, without you having to go out and take on more risk, and without you having to go out and give up control of your money, what you need to do is figure out how your money can operate with that perpetual tailwind. That's what you want. But the problem is today, your money is operating with a perpetual headwind. And that headwind will keep you from growing any faster. It doesn't matter what you do. Your money's operating in the wrong environment. Change one thing. Add one step, and that is where your money goes first, so that your money can operate in a financial tailwind.